So, let me pause because this is important. Before I go off on the deep end, you have to just really make sure that you understand how leases are accounted for. If it's an operating lease, which it is, 4 out of 10 is not substantially all. If it's an operating lease, you have an operating expense. That's why it's called an operating lease, because it has an operating expense. There is no asset, there is no liability, you charge it to the P&L, and that's how it should be accounted for. Framework. Framework. Is there a liability? ISA 17 says no. Forget ISA 17. Forget ISA 17. Let's look at this down to basic principles. Let's build the story up from zero. I have entered into a 4-year lease. I have entered into a contract. That is a past event. Under that contract, I am legally obliged to pay 10,000, 10,000, 10,000, 10,000, 10,000 a year. I have a legal obligation. I have a present legal obligation because I have signed a lease for 4 years. The settlement of that obligation will mean that I pay money. Oh my God, OMG. It is a liability. If you forget the word operating and finance and just look at what you've signed and created a liability. What is an asset? An asset is a resource that you control. I have the car for 4 years. I have the photocopier for 4 years. I decide when that photocopier is turned on. I'm in control of that photocopier for 4 years. I get the economic benefit from that photocopier for the next 4 years. There is a past transaction. I have signed the lease for the photocopier. I don't care about substantially all the risks and rewards of ownership. In the 4 years, I have a right to use the asset. In the 4 years, I control the asset. For that 4-year period, it's mine. I am in control. I have a right to use. Under the definition of the framework, that is my asset. So this is a totally different answer from ISA 17. ISA 17 is a rubbish standard. It's out of sync with the framework. It means you've got off-balance sheet finance. It's a standard which has had its day. It's about to be replaced. And the replacement is exclusively based on the framework, as you would expect, because the framework is your principles which guides the creation of new accounting standards. Blah, 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 blah. So the framework, how could it be? How could it be? So the framework here, what am I going to say? Oh. So the liability to pay the lease rentals, the liability to pay the lease rentals could be acknowledged, could be recognized, could be recognized. So the liability to pay the lease rentals could be recognized. The past event is the signing of the lease. The past event is the signing of the lease. There is a present legal obligation. There is a present legal obligation to make these payments. asset could be recognized. An asset could be recognized. An asset could be recognized on a right to use basis. So there's a present legal obligation to make these payments. An asset could be recognized on a right to use basis. We control the asset for the 4 years and benefit from using it. The framework gives me a different answer. The framework gives me a different answer. So we have a conflict between the standard, it's an operating lease, no asset, no liability, and the framework, which would suggest there is an asset, there is a liability. I'm comfortable with that. Going. I'm comfortable with that. Going. Yeah. Can you have a read about the property, please? Yeah? Can you have a read about the property, please? At the reporting date, the property portfolio was revalued. It's accounted for in accordance with IRC 16. There's a revaluation gain, resulting in a carrying value of the asset exceeding its tax base, and a taxable temporary difference arises. Under IRC 12, looking at deferred taxation, this is how you should account for it. A revaluation gain creates a taxable temporary difference. A revaluation gain creates a taxable temporary difference and creates a deferred tax liability. So a revaluation gain creates a taxable temporary difference, and therefore you have a deferred taxation liability. Make sure you're happy with that. It's a very simple example of deferred tax. You revalue the asset up, so the carrying value goes up, but the tax base remains the same because there is no current assessment for tax. So the revaluation gain is ignored for taxation purposes. Revaluation gain, taxable temporary difference, deferred tax liability. This is what you must do. Framework comes up with a different answer. I think. Help. Do I remember this or do I understand this? Let me try and see. I'm going to try and construct an argument which suggests that deferred tax is not a liability. I'm going to try and construct an argument which says IRC 12 is wrong. So, what is a liability? A liability is a present obligation arising from a past event, the settlement of which will result in an outflow of economic benefit. I have just revalued my asset. Because I've revalued my asset, the carrying value has gone up. When will I have to pay tax? On the disposal. I will only have to pay tax when I sell the asset. That will crystallize the tax liability. Am I presently obliged to sell the asset? No. So just because I have revalued the asset up doesn't mean to say that I'm presently obliged to sell the asset. So if I'm not presently obliged to sell the asset, I'm not presently obliged to pay the tax. I have no liability. One more time. When you revalue, you're under no present obligation to sell the asset, so you're under no present obligation to pay the tax. Ergo, deferred tax is not a liability. Let's write that down. On revaluation, there is no present obligation to sell. Therefore, there is no present obligation to pay tax, i.e., deferred tax is not a liability. There's a conflict between the standard and the framework. Now, there's lots of different ways this could be examined. I'm approaching it from the concept of the framework. Maybe the question could be about deferred tax and it's a twist. Maybe you could be asked your opinion on a weakness or something. It's a possibility it could come up in a number of different ways. But there is a classic conflict between the framework and the standard over deferred tax, particularly on the revaluations of property. Please, can we have a look at financial instruments?